bacon, orange juice, and the weather. But also stocks, crypto, Forex, gold, oil. In this video, we will talk about futures trading, where you can make money from pretty much anything. Alright, so let's begin here by asking the very important question, what is futures trading? And the simple definition here is that futures or a futures contract is when you lock in a buy or sell price at a future date. A future contract is an agreement to buy or sell an asset at a predetermined price at a specific time in the future, regardless of what the current market price is. And if this sounds a little bit complicated right now, don't worry, because we will take a look. We have an interactive tool here that I hope will make it really clear. But now let's take a look at why would we use futures? Who is using future contracts? Well, the first use case here is actually for producers to buy futures. And the reason producers would want to buy futures, let's say you are, producing, maybe you are buying corn, or you're buying, you need oil for your production. By buying a future contract, you are locking in a price today, so you know exactly what you will pay, but in the future. So this is a very good way for producers to avoid market volatility. So this is the use case for producers. But another very common use case, and this is probably why you are here, is that traders use futures to trade and speculate on price movements. And as you heard on the intro, you can use futures to trade pretty much anything. It doesn't matter if you are trading crypto, Forex, stocks, or even other things like oil and gold. You will find futures for pretty much anything. But now let's actually try to understand futures here together in a very simple step-by-step manner. So first of all, we can either go long, which means that we will buy something in the future, or we can go short, which means that we will sell something in the future. But let's start here by taking a look at the long. So the contract price here is the price that we lock in the future, and the market price at settlement is what the price is at that certain date. So as a very simple example, let's say that we decide today that we will buy one stock for $100 in let's say 1 month. So we will buy one stock for $100 in 1 month. And now let's fast forward 1 month. Let's say that the price after this month of the stock is 140. But remember that we have already decided that we're gonna buy the stock for 100. So if the price is 140, that means that if we right away sell the stock, we have made $40 in profit, right? We have made $40 because the stock is $40 more than our contract price. But the same thing, but the opposite is true if the stock has gone down. Let's say that the stock had actually fallen to $70. Now you can see that instead of a profit, we actually have a loss right here of $30 because we have already decided that we are gonna buy the stock at 100. So the difference here is our loss. And the same thing is true, but the opposite here for going short. If we're going short instead, we have locked in already that we will sell the stock. Let's, to make it simple, say that we locked in that we will sell the stock for $100, and after the month, the price, let's say that the price went down to $60. Well, in this case, this is great for us because we have already decided to sell at $100 and the price is right now at 60. So we actually make $40 in profit. So as you can see here, you can use the trading tool and you can see how the price affects your profit or loss. And by the way, guys, if you are interested in this tool, if you want to get this tool, let me know down in the comments, because I do plan to release many of these educational tools. I think I will definitely release them to channel members first. So if you're interested in becoming a channel member, you can check that out. That also really supports my work, so I'm super thankful for all of you. But as you can see here on the trading result, you can see, for example, you went short, agreed to sell at 100. At settlement, the market is now at 60. So you can sell the contract price at 100, which is higher than 60, and our profit is 40. I think this tool is amazing. It's very intuitive here. But all right, so now let's take a quick look at some different types of futures markets. As you know from the intro, we have so many different markets, but let's take a look at some of the most common ones. One very common market nowadays is cryptocurrency futures. So you can trade things like Bitcoin. By the way, if you want to learn more about Bitcoin, you know how Bitcoin works, I do have a video about that, so feel free to check that video out. But you can also trade things like Ethereum, Solana, and so on and so on. And one great thing about cryptocurrency trading is that the market is open 24/7. So you can trade on weekends, you can trade whenever you want. And if you guys are looking for a crypto exchange, and at the same time you can actually get up to a $30,000 bonus, I highly recommend to check out Bybit. I will make sure to have a special link to Bybit down in the description and the pinned comment. But cryptocurrency is very common. Another very common popular market here is the Forex market, where you can trade different currency pairs. So for example, the Euro USD, very common, but you can trade the pound, Japanese yen, and other contracts as well. Another super common, futures market, I think this is the most important futures market, is to trade different stock market indices, which means that you can trade entire stock market indices rather than individual stocks. This is super useful. You don't have to pick a specific stock. You can focus on the indices. This is pretty similar to ETFs, and ETFs stand for exchange traded funds. And if you want to learn more about that, I do have a short video where you can learn everything you need to know about ETFs. I will make sure to have that video linked as well. Last but not least, here we have the commodities market. Here you can trade things like gold, oil, corn, natural gas, and as I said, we have some very funny markets like, bacon, and it gets crazy over there in the futures market. In the commodity futures. But now let's shift the attention a bit here and take a look at some key characteristics of futures contracts. The first key characteristic is that they are standardized contracts. Means that we have specific terms, including the quantity, quality, deliver date, and settlement method. The other key characteristic here is leverage. You can control much larger positions than what you have in your account by using leverage. And here I think the concept of leverage is super important to understand. And once again, I do have a video about leverage. I will make sure to link that video up in the corner in the eye. Definitely make sure to check that one out. And here, this is super important. We have something called expiration. And this is that contracts have a specific expiration date when they must either be settled, which means that you will actually get the product, the product will be delivered to you, or they will be rolled over. For traders, you will never, you pretty much never want the actual product unless you want, to get a lot of oil shipped to your house. You probably want the contract to be rolled over instead, and we will talk more about that very soon. So here is a little bit more about that settlement. Most futures are cash settled, meaning no physical delivery. So this is, if you're watching this video, you're probably not interested in the physical delivery. But now then, what are the pros and cons of futures? Well, some of the advantages here is that with leverage, you can control large positions. So when the market goes up, say 5%, if you're using 10x leverage, you make 50%. So you can, of course, make a lot of money that way. But leverage is a double-edged sword because leverage amplifies both gains and losses. That is very important. Another big advantage of futures is that you can profit in both bull and bear market. You can profit from the price going up and you can profit from the price going down. But another risk here is the potential for margin calls, especially if you are using leverage here. The next advantage here is that high liquidity, which many futures contracts actually have, means that it's very quick and easy to enter and exit positions. One sort of risk here is if you are trading a contract with, complicated specifications and expiration rules, but as I said, don't worry about that. Pretty much all contracts you will trade will have automatic functions built in. Yet another advantage is low transaction costs many times. And another risk here is the risk of significant losses if we are not careful here. And that is why, and this leads to the next section here, which are 5 essential futures trading tips for beginners. My first tip here is start with paper trading. So before you dive into real futures, it can be a very good idea here to practice with a simulated account. Paper trading is basically when you practice with fake money. And if you want to get started with paper trading, I have a full course or full tutorial on how to get started with that. I will definitely make sure to link that video. I also highly recommend that you understand margin requirements before you start trading futures. So you want to learn about how initial margin and maintenance margin work. I definitely want to make a video going more into detail about this in the future. But for now, I highly recommend to just check out my video on leverage. The next tip here is start with micro contracts. So many futures offers something called micro contracts, which are designed for retail traders with less capital, like for example me and you. Also, this is very key. If you're trading, make sure to always place your stop loss and also be aware of the expiration dates. Alright, so last but not least here, before we wrap up, I want to take a little bit closer look here into expiration dates, because this is something that as a beginner you probably have lots of questions about. So first of all, let's get crystal clear about the definition. What is the expiration for futures? Well, a futures contract has a set expiration date, which is a specific future date on which both the buyer and seller have agreed to settle the trade. This is a key feature that is the difference between futures and spot trading. And here we have 2 different types of settlement. First of all, we have the physical settlement, and this is when you will get actual physical delivery of the underlying asset. So if it's gold, you will actually get gold. If it's oil, you will actually get oil. Here, as you can see here, if you're holding oil futures contract at its expiration, you might have to physically deliver or take delivery of oil. But as I said, if you are a trader, this will never in practice be true for you, because you will only do cash settlement. And this means that contracts are settled only financially. So traders simply pay or receive money based on the price difference. So for example, if you are trading stock market futures, you often use cash settlement, where your account is just adjusted based on how the futures perform. So to dive a little bit deeper here, what actually happens in practice? Well, in reality, most traders never hold futures contract until expiration. Instead, they take on one of these approaches. You either roll over So before the expiration, traders close the expiring contract and simultaneously open a position in a contract expiring at a later date. So this basically maintains the market exposure without dealing with the settlement. We also have something called perpetual futures. This is normal in crypto. If you have been trading crypto, you might have heard of this. And this is basically a crypto contract that never expire and automatically roll over. So these ones are basically designed for continuous trading. So here, some very important things to remember. Traditional futures contracts do not automatically roll over. But brokers typically close or liquidate positions approaching the expiration date. And here is just some repetition of the types of futures expiration. We have the traditional futures and the perpetual futures. But alright guys, so to really understand futures, I think it's super important to learn about leverage. So now I highly recommend to check out this video right here where I go over leverage step by step. I hope to see you all over there, but for now, take care. Ciao, ciao.